It is happening in driveways across America right now, usually at 2 or 3 in the morning when the suburbs are quiet. A tow truck backs up, killing its headlights to avoid detection. The driver steps out, quick and practiced. He doesn't knock on the door. He doesn't ask for the keys. He hooks up a Ford F-150 or a Honda Civic or a luxury SUV that was the pride of the neighborhood just a year ago. And within 60 seconds, the vehicle is gone. In 2025, this scene played out 1.78 million times. That is nearly 5,000 families losing their primary mode of transportation every single day. That is the highest number of vehicle repossessions since the darkest days of the Great Recession in 2008. But nobody is talking about it. The mainstream media is obsessed with AI stocks. They are focused on which tech billionaire is fighting with another in a cage match. They are ignoring the massive tectonic plate that is shifting violently beneath the American economy. And standing right on the fault line of this earthquake is a company that everyone knows, CarMax. You might think CarMax is just a friendly used car retailer with funny commercials. You might think their stock crashing 75% is just a blip, or bad luck, or poor management. But you would be wrong. CarMax isn't just a store. It is a bank disguised as a parking lot. It is one of the largest auto lenders in the United States, and its collapse is flashing a bright red warning light for the entire financial system. We are watching the bursting of the greatest credit bubble in consumer history. It started with cheap money. It was fueled by pandemic stimulus and greed. And now, it is ending in a wave of defaults that threatens to wipe out the wealth of the American middle class. CarMax is just the first domino to wobble. And if you want to know what happens next to your house, your job, and your 401k, you need to understand why this giant is falling. Welcome to the auto loan crisis of 2026. The addiction to cheap money. To understand this disaster, we have to look at the drug that caused it. That drug is cheap, easy debt. For over a decade, from 2010 to 2021, interest rates in America were effectively zero. The Federal Reserve flooded the system with cash to keep the economy moving. And Wall Street, awash in liquidity, needed a place to put that cash to earn a return. They found the perfect vessel, the American car buyer. Americans have a unique psychological relationship with their cars. It's not just transportation, it's identity, it's freedom. And Americans love buying cars they can't actually afford. CarMax, along with other dealers and big banks, started handing out loans like candy on Halloween. Did you have a credit score below 600? No problem. Did you have no income verification? No problem. Did you have $0 for a down payment? Sign right here. To make the monthly payments look affordable, they started playing a dangerous game with time. They extended loan terms. Historically, a car loan was 36 or 48 months. Then it crept up to 60 months. Then 72 months became the standard. Then 84 months. Now add in insurance, which has risen 20% in 2 years. Add in gas prices. Add in maintenance, the commuter tax. The cost simply to own and operate a vehicle to get to work exceeded $1,000 a month for millions of working-class families. Wages did not keep up with this explosion in cost. Inflation squeezed household budgets from every side. Rent went up. Food went up. Something had to give. The math simply didn't work anymore. And the first thing people stopped paying was the car note. The Wall Street casino, the securitization of misery. Now, here is the part of the story that makes this a systemic crisis, not just a retail problem. You might ask, if CarMax lends money to people who can't pay, isn't that just CarMax's problem? I wish it were that simple. But just like in the 2008 housing crisis, these bad loans didn't stay at CarMax. They were packaged, they were bundled, and they were sold. CarMax and other lenders take thousands of these auto loans, bundle them together into a financial security called an ABS asset-backed security. They take these bundles to Wall Street and sell them to pension funds, insurance companies, and mutual funds. Investors bought these bonds because they paid a slightly higher yield than Treasury bonds. They assumed that auto loans were safe. The old logic was, you can sleep in your car, but you can't drive your house to work, meaning people would pay their car note before their mortgage. But that logic has broken. Because of the massive inflation in car prices, people are walking away. And now, the investors holding these bonds are realizing they've bought toxic waste. The delinquency rates inside these bonds are spiking. If these bonds start to fail, it triggers a liquidity crunch. Lenders like CarMax rely on selling these bonds to get fresh cash to lend to new customers. If Wall Street stops buying the bonds, CarMax runs out of cash to lend. If CarMax can't lend, they can't sell cars. The entire machine grinds to a halt. The negative equity death spiraled the story of Mike. Let's bring this down to the ground level. Let's talk about a guy named Mike. The sticker price was $35,000 away over its historical value, but he needed a car. He financed it at 8% interest for 72 months. Mike still owes $28,000 on that loan because most of his payments went to interest. But the market for used SUVs has crashed. That Ford Explorer is now only worth $18,000. Mike is underwater by $10,000. This is called negative equity. Now, Mike's transmission starts slipping. Or maybe he loses his job and needs a cheaper car. He goes back to CarMax to trade it in. The sales manager runs the numbers and shakes his head. "I'm sorry, Mike. We can give you $18,000 for the trade, but you owe $28,000. To get out of this car, you need to write us a check for $10,000. Mike doesn't have $10,000. He barely has $500 in his savings account. So Mike is trapped. He cannot sell the car. He cannot trade the car. He is a prisoner of his own vehicle. In 2025, Edmunds reported that nearly 25% of all trade-ins had negative equity. The average amount of negative equity was over $6,000. This destroys the velocity of the market. The trade-in treadmill has stopped moving. Mike drives the car until it dies, or until he stops making payments and the repo man comes. The repo man is busy. So what happens when Mike stops paying? He enters the world of default, and the repossession industry takes over. This sector is currently the only booming part of the automotive economy, and it has gotten high-tech. Repo agents don't just drive around looking for cars anymore. They use license plate reader LPR cameras mounted on spotter cars that scan thousands of plates an hour. They drive through shopping malls, office parks, and apartment complexes. The camera pings, bingo, that gray F-150. 3 rows over. Some dealers even installed GPS trackers and remote disable devices on the cars they sold. If Mike misses a payment by 5 days, his car simply won't start on Monday morning. Then the tow truck comes to collect it. I have spoken to tow truck operators who say they are turning away business because they physically have no space to put the cars they are seizing. Repo lots are overflowing. They are stacking cars on top of each other. 1.78 million repossessions in a year. That is 1.78 million families losing their ability to get to work. And in the gig economy, this is fatal. Think about the Uber drivers, the DoorDash drivers, the Amazon Flex drivers. Their car is their factory. It is their livelihood. When the car gets repossessed, their income goes to zero instantly. It pushes them from the working class to the welfare line overnight. But economically, this creates a doom loop. When a bank seizes Mike's car, they don't want it. They are not a car dealer. They dump it at a wholesale auction to get some cash back. This floods the market with supply. When supply floods the market, prices drop even further. When prices drop further, Mike's neighbor, who is only underwater by $2,000, is now underwater by $5,000. More people fall into negative equity. More people default, and the cycle repeats. Down and down we go. CarMax is caught in the middle of this doom loop. They are holding the inventory, they are holding the loans, and they are holding the bag. The canary in the coal mine. This brings us back to why CarMax's stock is down 75%. Why they fired their CEO. CarMax Auto Finance manages a portfolio of over $17 billion in loans. And a significant portion of those loans are turning toxic. In late 2025, CarMax reported that their provision for loan losses, the money they have to set aside to cover bad debts, had to be increased significantly. This destroys their profits. Subprime delinquency rates in the auto market hit 6.6%. That is a higher default rate than we saw during the 2008 financial crisis. Let me repeat that because it is terrifying. More people are defaulting on their car loans today than during the Great Recession. And unlike 2008, we don't have a housing bubble to blame yet. This is purely a cost of living crisis. CarMax also wholesales cars. They are the market maker. But when dealers can't get financing to buy inventory, nobody buys at the auction. So CarMax is stuck with a massive inventory of depreciating metal. It is a melting ice cube. Every day, a car sits on a CarMax lot. It loses value. And CarMax is sitting on a veritable iceberg of losses. The bigger picture. Why should you care if you don't own CarMax stock? Why should you care if Mike loses his Ford Explorer? Because the auto loan market is a leading indicator for the entire economy. A car is usually the second most expensive thing an American buys, after a house. If people cannot afford their cars, they cannot afford their houses. We are seeing credit card debt hit all-time highs over $1.1 trillion. We are seeing buy now, pay later loans explode for groceries and basic necessities. The American consumer is tapped out. They have run out of savings. They have run out of credit. And now, they are running out of time. CarMax is just the first giant to stumble. But look at the other lenders. Look at Ally Financial. Look at Capital One. Look at the credit unions. They are all holding billions of dollars of this bad paper. If the default rates keep rising, we could see a liquidity crisis in the banking sector similar to what happened with regional banks in 2023. This is not just a CarMax story. This is a story about the end of the debt-fueled consumption model that has powered the U.S. economy for 40 years. The CEO of CarMax didn't just lose his job because he didn't sell enough cars. He lost his job because the tide went out, and everyone saw that the company was swimming naked. They built an empire on cheap interest rates and stable depreciation. Those conditions no longer exist. We have entered a new era of higher for longer rates and economic volatility. The companies that survive will be the ones with cash, low debt, and operational efficiency. CarMax, with its massive physical footprint and exposure to subprime loans, is a dinosaur in an ice age. The asteroid has already hit. We are just waiting for the dust to settle. So, the next time you drive past a CarMax lot and see those rows and rows of shiny cars, don't see them as inventory. See them as evidence. Evidence of a bubble that has burst. The resonance, now I want to hear from you. I want to know what you are seeing on the ground in your town. Are you seeing more repo trucks patrolling your neighborhood? Have you tried to buy a car recently and been shocked by the interest rates? Or maybe you are one of the millions trapped in negative equity, like Mike. Share your story in the comments below, because the data on Wall Street is one thing, but the reality on Main Street is what actually matters. And if you think the auto crisis is scary, you need to see what is happening in the commercial real estate market right now. It is the exact same story, but with bigger numbers and bigger buildings. Office towers are sitting empty, and the loans are coming due. Click this video right here to see why the next banking crisis might start with the empty skyscraper in your downtown. I will see you there.